If you're curious how a 529 plan can not only help you save for college, but can give you considerable tax benefits, then you'll want to watch this video, as I'm going to cover 5 tax benefits of contributing and investing in a 529 plan. Welcome back. This is episode 227. Contributing to a 529 plan can have many benefits for your children, grandchildren, and possibly even yourself when it comes to paying for college costs. And in this video, I want to talk about some of the other benefits that you might not be aware of, such as the tax benefits for contributing money into a 529 plan. Before I get into that, as a reminder, my goal in these podcasts and these videos is to help give you great information to help you plan for your retirement, maximize your returns on your investments, and hopefully reduce your taxes at the same time. So if you haven't already done so, consider signing up for my weekly newsletter where I keep you up to date on this latest information. To sign up for my newsletter, head over to retirewithryan.com and scroll to the bottom of the page and click sign up for my newsletter. So if you've been around for a while, you're probably familiar with a 529 plan. 529 plans were created in 1996, and so they've been around for a long time, and you're probably familiar that you can save for college, for your child's college, by contributing to a 529 plan. But you might not be familiar with some of the other benefits of 529 plans, and that are the tax benefits. So that's what I want to go over in this episode. So the standard thing to know about a 529 plan is that you put money into a 529 plan, you can then invest the money, and you can take the money out to pay for certain costs that can be covered costs, and they're considered a qualified distribution that are a tax-free distribution. So some of those costs are tuition and fees, room and board, books and supplies, computers and technology, special needs equipment, and even apprenticeship programs. What isn't covered, which sometimes people think are covered, would be transportation costs to and from school. So you can't buy your son or daughter a plane ticket or a train ticket with a 529 plan. College test prep or entrance exam fees, health insurance purchased through the school, or fees for extracurricular activities. Those are some of the non-allowed expenses. So let's talk about first I'm going to count down in reverse order in this episode, what is the number 5 tax benefit of having a 529 plan. So that number 5 tax benefit would be to be able to repay student loan interest and principal balance up to $10,000 per year per beneficiary, or for each sibling of the primary beneficiary of the 529 plan. So this was created as a result of the Secure Act, and this was then further expanded to allow for the repayment of both principal and interest. So it is lifetime up to $10,000 per beneficiary, or if you have other children, the siblings of the primary beneficiary. Because with 529 plans, when you set them up, you're primarily usually going to be the owner of the plan, and then you have to name a beneficiary. So you can't name multiple beneficiaries. So for that reason, they allow for other siblings to be able to use this to pay back the student loan interest. However, this is a lifetime limit. So let's say your child had multiple 529 plans. Maybe you have one and your parents have one for your child. They're still going to be limited to $10,000 lifetime between principal and interest, but it still is a good tax benefit. The second benefit for paying for tax benefit of a 529 plan, this would be the number 4 tax benefit, would be to pay for K through 12 education expenses. So normally when you think 529 plan, and I even mentioned it at the beginning of this episode, you're thinking college costs. Well, you could actually also pay for K through 12 costs. This was created a number of years ago, and you can use up to $10,000 per year to pay for tuition at private K through 12 schools. So this could be very helpful for a lot of people if you have a 529 plan balance that you want to tap into to use for these costs, or you can also just contribute to the 529 plan for this sole purpose of being able to use the money to pay for K through 12 costs. I will say there are some things that aren't allowed, such as books, room and board at any private K through 12 institutions are not allowed. And you also have to check with your state, because some states do differ as far as on what they consider a qualified tuition with a K through 12 private school. So that would be the number 4 tax benefit of a 529 plan. The number 3 tax benefit of the 529 plan would be tax deferral. Now, I mentioned this earlier. You put money into a 529 plan, you're able to invest the money. You have many different investment options. You can be very conservative and have it in a money market account. You can be a little more aggressive and put it into bonds, or you can be even more aggressive and put it into individual or into stock funds. So you have those choices, and you can mix it up from there. But you do have the benefit of having the money grow. That would be hopefully what happens in the 529 plan. So if you're able to invest money in your 529 plan, it then sits in there a number of years, maybe 10, 15 years until you use it for your child. You've gotten the benefit of that growth on the money. And one of the main benefits of the 529 plan is the tax deferral on that growth. So any dividends, interest, or capital gains that you have on the growth of that money is tax deferred, meaning you're not paying tax on that every year. If, let's say, your 529 plan was generating $1,000 a year of dividends, if that was not in a 529 plan, you would have to put that on your taxes and report that as income. So because of the 529 plan tax deferral benefit, you get the advantage of not having to pay tax on this money every year. So that's a big win, because that's potentially helping you lower your taxable income by not having to pay tax on this. But also the added benefit that all this money is then staying in the 529 plan. It's helping to further grow your account. You're getting the benefit of compounding, and also the benefit of not paying tax on this compounding. So that tax deferral is very beneficial. Sometimes people discount that. 529 plans sometimes get a bad rap. People think there's other ways to save for college that are better, and there certainly are other ways. It's up for debate whether they're better, but one of the biggest advantages of the 529 plan is the fact that you get that deferral. Now, if you then take it out, as we mentioned earlier, to use it for qualified expenses, you also are not going to pay tax on that. So you could have invested $10,000, maybe now it's grown to $20,000. You want to take that out to pay for qualified expenses. You could take out the whole $20,000. There's not going to be any taxes that are due on that money because it's a qualified expense. You're most likely, if it's qualified, you're not going to pay federal taxes and or state taxes. And if you do take it out for a non-qualified expense, just realize that you would pay a 10% penalty, and you'd pay taxes on only your gains. So your contributions to your principal will not be taxable. So in my example, you put in $10,000, it's grown to $20,000. Let's say your child never needed the money for college costs, and you want to just take it out and give it to them. You could do that. You would just pay a 10% penalty on your gain and or federal income tax and state income tax if you live in a state with state income tax. So that is the number 3 benefit of a 529 plan, the tax deferral. The number 2 benefit, in my opinion, of contributing to a 529 plan is the ability to do a Roth conversion. So this is a relatively new development. This just came out a couple years ago. So as a result of this recent announcement, I believe it was the Secure Act 2.0, you're now able to move up to $35,000 lifetime per beneficiary from a 529 plan into a Roth IRA for that individual. So I mentioned earlier about if you have a son or daughter or child who doesn't use your 529 plan, they were fortunate they didn't need it, maybe they got scholarships or they decided not to go to college, and you have this extra money, one way to get it over to them would be through this ability to help them do a Roth contribution. So in order to do this, you have to have the account open for at least 15 years. So that's one of the big hurdles, that the account needs to have been open for 15 years. And if you've hit that point and you've had a Roth IRA open for a while, or you could just plan to do that. You could plan, this could be part of your plan. If your child never needs it, you have this ability to then move this money over to a Roth for them. So you have to have it open for 15 years. And you also have to, your child has to have earned income equal to the amount that you're contributing for the Roth. So what is earned income? Well, earned income is some type of employment income for working for someone else, or self-employment income. So let's just say that you wanted to contribute the maximum amount to a Roth IRA for this year, which is $7,000. And they had a part-time job and they made $10,000 this year. Well, you have earned income equal to the amount that you want to make as a Roth contribution for them. Then you have the ability to make the Roth conversion from the 529 plan over to the Roth IRA, provided they've had the account open for 15 years. So that's a massive benefit, because not only are you able to contribute money into the 529 plan and get the tax-deferred growth, but if your child doesn't need all the money for college costs or K through 12 costs, then you can then move that money over to a Roth IRA for them down the road. Another big benefit of this is that normally with a Roth IRA contribution, there are adjusted gross income limits depending on whether you file as a single tax filer or as a joint tax filer. So if you are over those limits, there are no AGI limits in this scenario, meaning that your child can be very successful. Maybe they're making well over the adjusted gross income limits to make a traditional Roth contribution. Well, then they would be able to do it provided they had this 529 plan that was open at least 15 years. So it's a major advantage to have that 529 plan that's been open 15 years and have the ability to give your child a great start on investing, great start on saving for retirement by helping them get the money in a 529 plan over to the Roth account, so that now the money can be invested in their Roth account and they can then get the tax deferral of the Roth account. And then you're probably aware, but with Roth accounts, that money also comes out tax-free. So another thing that can work too is that you could potentially benefit from this. If you have had a 529 plan open for 15 years and your child doesn't need the money and you want to make a Roth IRA contribution, you can use it for your Roth IRA as well. So you can do the same thing. You'd have had the account open 15 years. You'd make yourself the beneficiary, which you can do. And now you can move that money over to your Roth, especially if you're over the adjusted gross income limit as well. So really some great tax benefits there, both for your child and for yourself. But remember, you have to have that earned income. So if you're retired, you'd need to go back to work, maybe part-time, earn enough money to qualify for the Roth, meaning you need to, for someone over 50, the maximum Roth IRA contribution is $8,000. You need to earn the $8,000, and then you can then move that over to a Roth in your name. So people often wonder, I did an episode on this. I'll put a link in the show notes to the episode that I did on this exact topic on the 529 to Roth conversion. Have a couple other videos too with more details. So definitely check that out. And one of the big keys usually is that it's a process that every 529 plan has. So you need to go through whatever their process is to do this, but it's not a terribly difficult process. So the number one tax benefit of having a Roth, of contributing to a 529 plan, is the state tax deduction that you could possibly receive. So there are a lot of states in the United States that have state income tax, and many of them also offer a tax deduction for contributing to a 529 plan. So there are 30 states that currently have a tax deduction for contributing to a 529 plan. My home state of Connecticut is one of them. So if you're living in Connecticut, Connecticut offers up to $5,000 per individual to contribute to a 529 plan. So that is deductible on your state income tax. So let's just assume you're in the 6% tax bracket for Connecticut state income tax, and you put in $5,000. Well, that's going to save you $300 in state income tax. If you're a married couple, you could also each put in $5,000. So that could then double the savings up to $600, assuming a 6% tax bracket. So that's a major savings, because that's savings you're getting right now, and that's per year. So you could do that every year, put in the $5,000 or $10,000 and receive that state tax benefit. Some other states that are close to me that offer them, New York currently offers a $5,000 tax reduction. Rhode Island offers only $500 per person. New Jersey offers $10,000 per person. So definitely check out whether or not your state offers a state tax reduction by contributing to a 529 plan. And the other thing that you really want to know is that does your state allow you to do this only if you contribute to your state's plan, or can you contribute to any plan? So in my home state of Connecticut, you have to contribute to the state 529 plan. There's two plans, and I usually suggest using the direct plan, which is the CHET plan. And if you go to, I believe it's aboutchet.com, Fidelity administers it. You can then open up an account and contribute. And if they do use any plan, then you could choose whatever 529 plan that you feel is best for you. And so the states that allow you to contribute to any 529 plan and still get that state tax deduction are Arizona, Alaska, Kansas, Minnesota, Missouri, Montana, and Pennsylvania. So there are a lot of other states that offer it. I said there's 30 states, but they require you to contribute to your state's 529 plan. But usually the biggest thing to know about this is calendar year based. So because we're getting close to the end of 2024, if you haven't made a 529 contribution yet, and you're in a state that's going to give you a state tax benefit by contributing, then you should make the contribution before the end of the year. So definitely be aware of that. We have a couple months left in the year to be able to contribute to these plans. Still have some time. But things go quick. Make sure that you do this. And the first step would be that if you don't have a 529 plan opened with that state plan, if you need to contribute to that, open the plan and then contribute to the plan. So again, these are the top 5 tax benefits for contributing to a 529 plan. And I hope you found this helpful. If you do need to contribute to a 529 plan to take advantage of the state tax deduction, make sure you set the account up and do it before the year is over. And also make sure that you remember to tell your accountant that you made this contribution so you could actually benefit from this on your taxes. I hope you found this episode and video helpful. As always, if you have a listener question, head over to retirewithryan.com and click on Ask a Question to have that question considered for a future episode. Have a great week, and I look forward to talking with you next Wednesday. Take care.